Hello, welcome everyone, and thank you for joining today's market update. I'm Nicolas Mauricio, managing partner here at BlackPoint Capital Partners. I'm also joined by Arun Kaul, our outsourced chief investment strategist. Arun has nearly 30 years of experience in institutional portfolio construction and macro strategy, and leads our investment committee and model design process here at BlackPoint. Today, we will walk through what we're seeing in the markets, specifically on GDP growth, labor market trends, Fed policy, credit spreads, real estate, and how this impacts portfolio positioning as we head into the final quarter of the year. Before we begin, please note this is a quick disclaimer. This presentation is for informational purposes only and it is not investment, tax, insurance, or legal advice, and all views are based on current market conditions, which may change. Clients should consult their advisor before making any investment decisions. With that said, let's go ahead and get started. Arun, over to you.
All right, thanks, Nico. So on the economic front, the most recent expectation for Q3 GDP in the US is growth of around 3%. And this follows a recent revision to Q2 growth, which initially came in at 3 and then was revised upwards to 3.3. So this quarter and the last quarter, fairly strong from an economic growth perspective in comparison to Q1, where we had the negative 0.5% print, which in part was impacted negatively by tremendous amount of front running on imports in anticipation of potential tariffs from the administration. So if you put all those three quarters together, fairly strong to moderate, kind of moderate to strong growth for the US economy overall. Even though we're seeing some softness in payrolls, we're definitely seeing more growth from the CapEx investment perspective and certainly foreign direct investment in the US.
Great, and I guess just the big question on there, Arun, double click there. It seems to be labor data is pretty much what everybody's looking at. So with that being said, just things do seem to be kind of slowing down a bit. How do we interpret this labor data? Is it softness? Is it payroll deceleration? And then I guess the big question is this any recessionary indication at this point?
Right. So there is certainly a lot of talk that maybe it is comparable to certain levels we saw in 1990 and 2001 that did precede recessions, because the overall payroll growth right now is about 1%. I.e. growth as a percentage of total payrolls. However, we do have a pretty mixed backdrop given that we have some fairly aggressive immigration enforcement coming on. We've had some very significant revisions to payroll data, and we are seeing some softness in the payroll numbers. So I think for now, it's a little bit too early to call on a recession, but certainly there's a lot of interpretation required behind some of the data and behind some of the macro activities that we're seeing in the US economy.
Okay, perfect. Thank you very much for that, Arun.
Yes, so just on to policy, Fed policy. Now we are expecting 1 to 3 cuts from the Fed on the short end of the curve for the remainder of this year. If you look at 1-year and 2-year Treasury bills, they're already moved down towards 3.8 and 3.6%, which would be equivalent to about 2 cuts. So that's what the market is priced in. And the 10-year has been fairly stable, staying at about 4.2% for the last year. Now it's oscillated around that, a little bit lower, a little bit higher, but basically in between 3.8, 3.9 up to 4.3, 4.4, 4.5. But the average around 4.2 has been fairly stable.
Okay. Go ahead, Arun.
So effectively, reasonable borrowing costs, certainly for larger borrowers, for S&P borrowers, for borrowers with higher credit, and for investment grade borrowers.
Great. No, I think that makes a lot of sense. And I guess the big question here is, if we were to expect 2025 to have 1 to 3 cuts, that does seem, I mean, given the fact that we've waited this long, seems to be a pretty heightened cycle of interest rate cuts. Is that too fast for the Fed to consider that, given the fact that GDP is still strong at the moment? I guess the big question is this data driven or is this, market driven from that side of things?
So I don't think it's too fast from the Fed perspective. If you look at inflation, we are above target. So the Fed wants to be at around 2. We're at 2.5 towards 3, depending if you're using core or headline numbers. But if we use the headline numbers, the 10-year against around 2 to 2.5% inflation is almost 200 points of real return. That's about the long-term average. So given that we have a fairly good real return on both the 10-year and on cash in the US, I think the Fed has room to cut. And I think you will see them cut, and we probably see some cuts into next year as well.
Perfect. Thank you very much. And I guess that leads us on to the next topic, is pretty much what everybody asks when it comes to interest rates. Can you talk to us a little bit more about mortgage markets and credit spreads across the globe?
Yeah, so what this graph is showing is the 30-year Treasury rates for the 30-year Treasury, US Treasury, and this has continued to rise or to drift higher. So that is impacting mortgage rates in the US. So we're not getting as much relief on the mortgage side, even though rates on the short end are coming down. The long end, which most homeowners have or are exposed to on the home equity side, those rates have not come down. So we're still seeing some pressure in the housing market. Prices certainly are higher relative to incomes. But if you look at spreads for AAA borrowers, for investment grade, even mid investment grade and high yield borrowers, those spreads are very tight. So we've got pretty good financing rates for corporate America and for high quality borrowers in the US.
Okay, and I guess that leads us on to one of the major questions. Obviously, a lot of clients love to look at real estate investments as a whole, and I guess what does that mean? What should we be keeping an eye on for clients who potentially want to look at some more investments on that side of things, whether it be commercial real estate? Obviously, the big question as well, is there a shortage of housing, and what's the supply look like? Any thoughts on that, moving into the rest of 2025 and 2026 there?
Right, and those two markets are significantly bifurcated. So commercial real estate has seen significant reductions in price, in part because a tremendous amount of the deals were done in 20 or 21 when rates were extremely low, and cap rates have had to adjust and move significantly higher since the Fed started raising rates, which has caused commercial properties to come down in price. It's close to 10 to 15%, depending what region of the country some of these commercial properties are in. Residential has been different. We have not seen that level of stress across the US at the residential level. And certainly we have a pretty significant shortage of housing in the US. We've had a lower number of housing starts than we have had household formations. So we're still running a net deficit. Depending on the numbers you look at, it might be 750,000 towards 1 million to potentially over 1 million in terms of the number of houses that we are short, given the growth in household formation. So I think there's still strong supply or demand drivers on the residential side for real estate.
Okay, perfect. And then thank you very much for that, Arun. And I guess just really last couple of slides here. Let's talk a little bit more about credit positions and credit conditions and potential some global positioning. Could you give us a little bit more thoughts there and some of the charts that we're looking at here?
Yeah, so we've definitely seen this. This chart is the main blue line is showing bank credit growth. So bank lending, which is definitely growing at a slower pace this cycle than it has in previous cycles. However, what we have seen as well is a pretty significant growth in private debt and private credit markets. And growth there has been strong, in particular middle market, which are the non-exchange traded firms that are small or medium-sized businesses in the US. They have tremendous access to credit from private market participants, whether it's private equity funds or private debt funds in that space. So they do have reasonable access to credit to support growth in their markets.
Great. And just, I guess the big question here then is, well, does this make private credit a more attractive investment for retail investors?
I think it's definitely an area that retail investors should be considering. Right now, the spreads in private credit, which tend to drive off of short-term rates. So if short-term rates are around 4.5, borrowers might pay 4.5 to 5 to 6% more for private debt for middle market companies or middle market borrowers. So the yields can be quite attractive, could be 8, 9, 10%, depending on the sector. And they tend to be in the first lien position, meaning they're at the top of the capital structure, so they're well secured in the event of any adverse situations for the businesses. So I do think that it's definitely it's an area that private clients should be looking at.
Okay, perfect. And thank you very much for that. I think that's really something that we can continue to consider in portfolios across the board as we move into the back quarter of the year. And I guess just last part, just some of the big key takeaways. Could you really just hit on just the difference between U.S. equities versus developed market equities, and just kind of bring us home here, Arun here.
So the big difference remains that the large U.S. tech firms have tremendous growth profiles still, and they have very, very profitable business models, which means they have very high margins. And all of that adds together to higher valuations. And they're still largely US based. If you look at European tech firms, there are literally none of the top 20 firms in Europe are technology firms, maybe one or two, and they're certainly not at the scale that the US firms are. So this dominance, this chart is just showing value, growth against value. Growth is won for almost 15-year period, except for a drawdown in 22 and 23. You've really seen the growth dominate, and that's the Mag 7 and the large tech names in the US. That's still continuing. There certainly is a spread on valuations, but there's also a big spread on growth and margins. And that's really what we're keeping an eye on going forward in terms of the growth and margin differentials between growth names and value names, and if we think it can persist for some of these larger cap US names.
Yeah, great. No, Arun, always appreciate your insight. Thank you very much for taking some time today. And I guess really just to recap for everybody who's listening, GDP growth is still solid, but labor data is showing some cracks. Fed is still likely to cut before the end of the year. The only question is, well, how fast do they cut? Credit remains favorable, but spreads are continuing to tighten. And mortgage affordability does continue to worsen, something that we just talked about there with Arun. But I guess the big thing and the big takeaway is U.S. equity leadership is still intact, and it's really for us to stay, really more selective when it comes to any of the strategies that we're looking to implement. But as always, if you'd like to discuss or how this affects your portfolio or how we're positioning any of the asset classes across your portfolios, please reach out to your team, whether it be your advisor or obviously the info@blackpointcp.com general inbox. We'd love to work with you. Thanks for joining us today, and thank you very much. Thank you very much, Arun.
Thanks, Nico.